Welcome to this explainer. Right now, behind the scenes of global finance, the insurance industry, which is basically the foundation of our entire economic stability, is practically scrambling. They're trying to mathematically calculate the rapidly growing threats of climate change. Specifically, we're going to look at how physical risk exposure is completely changing the game for how insurance is written, priced, and managed.
Think about it for a second. What happens when the literal shock absorbers of our economy, the insurers, face massive, totally unexpected claim payouts just because they failed to properly price environmental risks? Well, if extreme weather events, like major hurricanes and severe floods, keep increasing in frequency, and insurers haven't priced those exact risks into their individual underwriting contracts, the resulting unexpected claim losses could literally trigger a massive financial domino effect.
So here's our roadmap for today. We'll be covering the climate threat, modeled versus non-modeled risks, probable maximum loss, pricing environmental risks, and finally, entity-level risk management. Let's dive in.
Section 1, the climate threat.
Okay, so the core function of the insurance industry is essentially to absorb unexpected economic shocks, right? But that core function is under direct threat. The 2025 Sustainability Accounting Standards Board guidelines lay out a pretty stark financial reality. They state, catastrophic losses associated with extreme weather events will continue to have a material adverse effect on the insurance industry. So this isn't just some theoretical, distant environmental warning. It is a recognized financial fact that climate change is driving up the frequency of extreme weather, and insurers absolutely have to adapt. Now, the Task Force on Climate-Related Financial Disclosures takes this massive, complex threat and breaks it down into three distinct buckets. First, you have transition risks. These deal with things like asset value declines or new carbon regulations. Then liability risks, which look at the potential spike in climate-related litigation. But the most direct threat to property and casualty insurers, and the one we are laser-focused on today, is that very first point, physical risks. We're talking about the raw physical impact of changing frequencies and intensities of severe weather perils. Which brings us to Section 2, modeled versus non-modeled risks. To actually manage these physical risks, insurers have to rigorously classify the types of disasters they're facing. Historically, they've divided natural catastrophes into two main camps. On one side, you have modeled risks. These are your large-scale, headline-grabbing events. Think massive hurricanes and major earthquakes. The industry has spent literally decades analyzing these. But the great irony here? It's found in the non-modeled risks. These are the smaller-scale, everyday events like localized floods, intense droughts, extreme heat, or severe snowstorms. And actually, because climate change is rapidly increasing their frequency, these non-modeled events are becoming some of the most persistent and costly threats out there. So to avoid getting caught off guard by unexpected claim losses, insurers rely heavily on CAT models. Now, what are these? They're basically probabilistic, mathematical models that simulate hazardous events and estimate the potential damages and insured losses that would come with them. Understanding these simulations is absolutely crucial because this, right here, is how insurers actually figure out how to put a real-world price tag on a future disaster.
Moving right along to Section 3, probable maximum loss.
You might be wondering, how do insurers actually know how much money they stand to lose when a massive storm hits? Well, the answer lies in something called probable maximum loss, or PML. Put simply, this is the anticipated value of the absolute largest monetary loss that could affect an entire portfolio from weather-related natural catastrophes. It is the ultimate worst-case scenario calculation. And if they get this calculation wrong, their capital reserves will fall dangerously short when disaster actually strikes. To figure out this gross PML, insurers run what are called exceedance probability scenarios. Basically, they stress test their portfolios against a 1 in 50-year event, which has a 2% likelihood of happening. Then a 1 in 100-year event, or a 1% likelihood. They even go all the way up to a 1 in 250-year event. That's a super rare 0.4% likelihood scenario. By mapping these exact probabilities across specific perils, from hurricanes to extreme heat to winter weather, every single cell in this matrix becomes a massive, complex financial calculation. The whole point? To guarantee they are adequately prepared for the worst. All right, Section 4, pricing environmental risks. So now that we know exactly how insurers measure these absolute worst-case scenarios, let's look at how those mathematical measurements are actually priced into the individual contracts we all buy. The outputs from those CAT models directly dictate the underwriting process across three main steps:
Step 1, product development. Insurers use the models to figure out what kind of insurance products can even be built in the first place to account for these climate risks. Step 2, pricing of policies. Look, if the frequency of floods is going up, the premiums for flood insurance simply have to go up. Otherwise, the insurer faces massive, unexpected claim losses. And finally, step 3, client and cedent selection. This is where an insurer might look at the data and decide, you know what, this specific geographical market is simply too risky to cover it all. At the end of the day, the math entirely dictates the market.
But here's the really interesting part. Insurers don't just sit back and react passively to risk. They actively try to shape it. They actually use their pricing structures to incentivize policyholders to physically protect their assets against climate change. For example, they might offer premium discounts if you use sustainable building materials or improve your resource efficiency. They actuarially adjust premiums for enhanced weather resiliency. They even favor covering properties in communities that go out of their way to mandate strict building codes requiring climate risk adaptations. It's pretty smart. By rewarding responsible behavior, they effectively lower the overall risk of their underwriting portfolio. Which brings us to our final section, Section 5, Entity-Level Risk Management. Zooming out from those individual contracts for a second, we really have to look at the entire insurance company's overall survival strategy. Why? Because extreme weather events are highly correlated, meaning a massive hurricane doesn't just hit one house, right? It wipes out a whole coast. So a sudden influx of disaster-related claims could easily and very quickly bankrupt an insurer. To prevent this nightmare scenario, they run a massive entity-wide assessments to ensure long-term capital adequacy. They do serious contingency planning for total market failure, and they utilize alternative risk transfers, like catastrophe bonds, to spread that risk out into the broader global capital markets. These tools aren't just nice-to-haves. They are absolutely critical for maintaining global economic stability. And that brings us to the absolute core takeaway of our explainer today. Accurate pricing of environmental risks isn't just about protecting corporate profits. Not at all. It is literally the only way the insurance safety net survives climate change. By perfectly pricing physical risk exposure into every single individual contract, insurers ensure they actually have the funds required to pay out claims when the worst-case weather scenario inevitably becomes a reality. So we've seen how insurers meticulously measure and price risk. But it leaves us with a pretty huge question. If the frequency and severity of extreme weather continue to rise to a point where the math simply breaks down, what happens to global economies if climate change renders entire high-risk regions completely uninsurable? It's a massive macroeconomic question that everyone, from your average homeowner to global policymakers, will have to answer in the years ahead. Thank you so much for joining me on this explainer, and as always, keep questioning the data.